Welcome to the 6th edition of the Happy Investing Show. I answer all your questions about insurance and investing. I've got 3 interesting questions in this week. The first question is from Abhishek Agarwal from Delhi. He has asked something which is very commonly misconstrued. Is it good to invest in lower value or lower NAV mutual funds? The NAV is nothing but the price at which that particular mutual fund is currently valued at. It doesn't matter whether it is 3 digits or 5 digits or 2 digits or single digit. It is just a reflection of how well the growth has been or how new is the mutual fund in itself. In fact, where people think that investing in lower NAV mutual fund is better, on the contrary, it is better to invest in higher NAV mutual fund primarily because it shows that the fund has grown well over a longer period of time. The lower NAV also may be because the fund has been giving out a lot of dividends. So there is no way to assess or there is no proof to say that lower NAV mutual funds are better than higher NAV mutual fund. This is absolute misconception. Don't fall for it. Always do a good research, understand more about fund manager, understand about the fund history and then invest. Don't worry about the price. I hope I answered that question. The second question is from Sachin Huda from Mumbai. He is 27 years old. He's asked me a good question. He says, what is an expense ratio of a mutual fund? Thanks for asking me this question, Sachin. Expense ratio is nothing but the fund management charge or the cost of managing that particular mutual fund for all of us investors. So let's say you have invested 100 rupees in a mutual fund and the fund manager charges 2% on an annual basis, and that is the expense ratio. All it means is that over the next 365 days of your holding, let's assume that you hold for 1 year only, that 2% will be charged every day. Now don't get me wrong. It is 2% divided by 365 into the NAV of the fund. That will get charged every day on that particular mutual fund. Expense ratio is nothing but the cost of managing that particular mutual fund by the fund manager, and this is decided by the fund house plus also by SEBI. I hope I answered that question, Sachin. The third question is from Sumit Mathur, who is from Kanpur. He's asked me a question which is very sweet. His question is it okay to invest or keep the money in debt or liquid funds even when the market is at all-time high? A really nice question, and a lot of people might be having this because many wouldn't have invested into the equity markets also. There is absolutely no right or wrong answer to this, primarily because investing in debt or liquid fund is very personal. Maybe you're young, maybe you're old, but it all depends on your risk profile, whether you should invest all your money in equity, 50% money in equity, 50% in debt, or all your money in debt. I have investors who started with me at the age of 35 with 100% debt portfolio. Is this something wrong? Not at all. That's what he wants. And I also have people who are at 55 and have close to 70 to 80% of their money in equity. So there is nothing right or wrong about keeping money in debt portfolio. Yes, you should always look at the purpose of that money, and if the money is for long term, then don't shy away from putting the money into equity. And if it is for short term, of course, even if you're a high risk profile, don't invest your money in equity for short term. After all, it's personal finance. It is called personal for a reason. It is very unique to you. So don't try to copy someone else's plan. Thank you for watching this show. Please keep asking me this question. Till then, happy investing.